Welcome to the next session, and we want to go to our next accounting standard, and we are looking at IAS 2 inventories. Now, when it comes to treatment of IAS 2 inventories, I referred to this in the previous session. It's one of the easiest standards that you can understand. Technically, inventory is valued at lower of cost and net realizable value. In other words, we just look at the cost we incurred in acquiring the inventory, in manufacturing the inventory in-house, and the net realizable value. Now, stay with me carefully. When we say the cost of the inventory, what does it mean? It means purchases cost, how much cost we incurred in buying the inventory. Note that usually the cost of inventory excludes storage cost, excludes cost of selling the inventory. If it happens that we manufacture the inventory in-house, then the cost of inventory will include the direct material cost, the direct labor cost, the direct expenses that we incur, then any directly attributable factory overheads will be included, and that will give us the cost of the inventory. But that is the first aspect. How do we determine net realizable value? Simple. Net realizable value is the selling price minus the cost to sell. So net realizable value is the selling price or the fair value of the asset minus cost to sell. That's how we get a net realizable value. So when we say the cost to sell, it is the estimated cost of completion. Sometimes the inventory is damaged and so we need to repair it. Or the inventory is still work in progress. It's not completed yet. So in order for us to sell it, we have to finish it, because there are 3 levels of inventories. We have, or maybe 4 or 5. We have the raw materials, we have the work in progress, we have the finished goods, we have spare parts. But let's deal with the first 3. So raw materials, work in progress, and then finished goods. So sometimes you will not be able to sell work in progress. So for us to sell the product, which is the finished goods, we would have to work on the work in progress and turn it into the finished goods. So the cost incurred to complete the product from work in progress to finished goods will be included in the cost to sell as well. And estimated cost necessary to make the sale, like marketing, selling, and distribution cost. All these things will be included in determining the cost to sell and subtracting that from the fair value of the asset, and that will give us the net realizable value. Usually, when we want to determine the cost of inventory when it comes to preparation of the cost of inventory, we have to prepare what we call the cost ledger card. The cost ledger card. You did this in management accounting, KG2. And under the cost ledger card, you will look at the first in, first out method, or the weighted average method. And that is how we determine the movement of inventories with their value at the end of the day. So basically, when we talk about inventories, that is all there is. And that's all you must understand when we talk about inventories. But let's get excited to look at an illustrative question here about how inventories can be valued. Very sweet, simple question here. We want to look at it and see how inventories can be valued. So let's see. The requirement here is to calculate the cost attributable to products 1 and 2. Calculate the cost attributable to products 1 and 2. So let's see what we got here. So let's see. A production line results in 2 outputs, product 1 and product 2. Parts of the production process give rise to indirect cost specifically identifiable with only one of these products, although other costs are not separately identifiable. So we see product 1, we see product 2. So the question we need to ask ourselves is the requirement of the question, cost attributable to each product. So let's work it out. So cost attributable to, let's say product 1 here. So direct cost, let's bring it up. And that is an amount of 140,000. Then we bring in indirect production overheads. I want you to stay with me well. Indirect production overheads. We see identifiable. That is 37,000. Indirect production overheads, and that is the identifiable. And that is 37,000. Let's go. Then it says other. The other is 50,000, but nothing is allocated between the product 1 and product 2. Maybe later on the examiner will tell us about it, but for now, that is the idea about the product 1. Now, the same information could be duplicated for product 2. So this will be product 2. The direct cost for product 2 is 160,000. The identifiable overheads, it's 45,000. So let's see. Let's continue to read. Budgeted output in units, 690 for product 1, 900 for product 2. Let's see. The entity has a policy which allocates indirect costs which are not specifically identifiable to an individual product by reference to relative selling prices. This results in 60% being allocated to product 1 and 40% to product 2. So in our workflow here, the other overheads, 50,000, must be allocated. 40% to product 2, 60% to product A. So others, we take 60% of 50,000. Others, 40% of 50,000. So that gives us 20,000 here and then 30,000 there. Let's continue to read. During the month, costs were incurred in line with the budget, but due to a failure of calibration to a vital part of the process, only 675 units of product 2 could be taken into inventory. The remainder produced had to be scrapped for zero proceeds. So this is our information. So let's get a total cost of inventory as per the budget. So total budgeted cost of inventories, 140, 37, and 30. That is 207. So based on this, we're going to calculate the cost per unit. Okay, the cost per unit is going to be 207,000 divided by the budgeted unit of 690. That's 300. Let's go to product 2. The total budgeted cost, 160, 45, 20. And that is 225,000. So let's bring in the cost per unit of product 2, 225,000 divided by the budgeted unit, 900. And that gives us an amount of 250 per unit. So this is using the budget information to get a cost per unit. Based on this, we have to look at the actual thing that happened, then we can work ourselves out. It says that during the month, costs were incurred in line with the budget, but due to a failure of calibration to the vital part of the process, only 675 units of product 2 could be taken to inventory. What does that mean? It means that none of product 1 was made, partly due to the failure of calibration. So let's look at the cost of the, because remember the context of the question, it says calculate the cost attributable to products 1 and 2. Cost allocation to products 2. So let's see. It says that only 675 was taken into inventory. So 675 times the cost per unit for the second product, which is 250. That is 168,750. Remember they said the remainder produced had to be scrapped. So what is the remainder? Remember product 2, we are supposed to make 900. So 675 minus 900, or 900 minus 675 will be 225. That has to be expensed in the P&L account, because if it has to be scrapped, it has to be expensed. So profit or loss as expense will be the 225 units that went into scrap times the 250 per unit. And that will give us an amount of 56,250. So that is the answer to this question. So I'll see you in the next video as we look at another question when it comes to dealing with inventory.